Today I'm going to be talking about money and the banking system. First things first, what is money? Yeah, it's a crumpled up green thing in your pocket, sure, but money is also a highly valued asset that performs three basic functions. First, and above all else, it acts as a medium of exchange so we can buy and sell goods and services. Without money, we would be living in a barter economy. Luckily, money simplifies transactions so we don't have to trade for what we want, and it also reduces the cost of these transactions. The second thing money does is provide a means of storing value for future use. Money is an asset that allows people to transfer purchasing power from one period to the next. The disadvantage of using money as a store of value is that the value of money is inversely related to the price level in the economy. So if inflation rises, the purchasing power of money declines, which means so does its usefulness as a store of value. The last basic function of money is that it is used as an accounting unit. It serves as a unit of measurement used by people to post prices and keep track of revenue and costs. The value of everything from clothes to cars to castles is measured in units of money. This allows consumers to make comparisons between products and make informed spending decisions. Let's pause for a second and go back in time. Obviously, we didn't always have money as we know it today. So how did people make exchanges and transactions? Well, it started with bartering or trading. The problem was that it was impossible to compare the values of items like apples to chickens. And in this example, if Mahir wants Johnny's apples in exchange for his chicken, but Johnny doesn't want a chicken, the transaction cannot take place. We needed a universal means of exchange. We needed a commodity money. Commodity monies have 5 important characteristics. They must be relatively scarce and recognizable as an accepted currency. They must be able to divide into smaller pieces like the nickels and dimes we have today. Commodity monies have to be able to be exchanged for equal value, and they must be easy to carry. With these characteristics in mind, people have used all kinds of items as commodity money. Shells, grains, beans, cigarettes, salt, and even animal dung at one point. Eventually, coins allowed for more trade than ever before. However, political distrust and debasement of the coins led some people to doubt the actual value of the coins they were using. International merchants came up with a solution to this with their idea of IOUs, because they realized that debt had value. This could have been considered the first paper money. Fast forward to America, where Congress has the exclusive right to coin money, and money's value was tied to gold. Eventually, the American dollar became the most trusted currency in the world. However, after years more debasement of coins and distrust of value, President Nixon declared that money would no longer be backed by gold, but rather by trust in the American government. Now that our little history lesson is over, let's get back to talking about money and banking today. We'll start with the money supply. Okay, so we already know that the price level in the economy affects the value of money, but so does the supply of money. Of course it does, because the thing that makes money valuable is the same thing that generates value for all other commodities. Demand relative to supply. The reason people demand money is because it lowers the cost of transactions and exchanges. If the supply of money expands relative to demand, it becomes less valuable. And on the flip side, money becomes more valuable when the supply is limited relative to demand. Now we know what money is, and we know what affects its value, but how do we measure it? The two most broadly used measures are called the M1 money supply and the M2 money supply. M1 focuses on function. Included in the M1 money supply is currency, checkable deposits, and traveler's checks. M2 is a much broader way to measure the money supply. It includes the same factors as M1, plus savings and deposits, time deposits in depository institutions of less than $100,000, and money market mutual funds. Many economists prefer the M2 definition of the money supply. The size comparison between the two measures are drastic. In April 2013, M1 added up to a total of $2,524 billion. M2, on the other hand, was measured at $10,527 billion, almost 5 times the amount of M1. The Federal Reserve System is the central bank of the United States. It regulates the banking system and controls the money supply, and is responsible for conducting monetary policy. Commercial banks, savings and loan associations, and credit unions are all a part of the banking industry under the jurisdiction of the central bank. Banking is a business, and banks are profit-seeking operations. They earn most of their profit by extending loans and investing in interest-earning securities. It is also important to note that when banks extend loans, they create additional deposits and thereby expand the money supply. The United States has a fractional reserve banking system, which is a system where banks are required to maintain only a fraction of their deposits in the form of reserves, which is vault cash or deposits with the Fed. Let's talk more about the Federal Reserve System. The purpose of the central bank is supposed to be to regulate the money supply and provide a monetary climate that is in the best interest of the economy. Congress has asked the Fed to conduct monetary policy in a way that will promote full employment and price stability in the United States. So how does the Fed control the money supply? It has 4 major tools to do this. 1. The establishment of reserve requirements for banks. 2. Buying and selling U.S. government securities and other financial assets in the open market. 3. The volume of loans extended to banks and other institutions. And 4. The interest rate it pays banks on funds held as reserves. If the Federal Reserve System wanted to increase the money supply, it could decrease reserve requirements, purchase additional financial assets, extend loans, and/or lower the interest rate it pays banks on excess reserves. This would be the example of the central bank practicing expansionary monetary policy. The Fed typically only looks to inflict a small change in the money supply at any given time, so typically only one of these tools would be used at a time. Open market operations, which is the buying or selling of bonds and other assets, have been the #1 tool used by the Fed to alter the money supply. To end with a quote from the one and only Milton Friedman, "Money is whatever is generally accepted in exchange for goods and services, accepted not as an object to be consumed, but as an object that represents a temporary abode of purchasing power to be used for buying still other goods and services."